workshop, I think.
Third
time doing this workshop. So it always ends up being a workshop where you guys will have lots of individual questions about the taxes that are involved in your business. Siraj, I already told him that you're going to try and stump him with some questions, so I'm really excited to watch that happen. And so please feel free to ask your questions. Use the reactions or raise your hands along the way. We can see you guys on the side of our screen. And Taylor's gonna run through some key things about taxes for small business. So without further ado, Taylor.
Thank you very much.
Oh, you're so welcome.
Welcome to the Small Business Tax Workshop. As Kelsey said, the actual workshop is, 2.5 pages of bullet points, but at the end of the day, what people usually seem to get the most out of is asking questions. In general, I can answer most of the individualized questions that you can come up with for your specific business. And at the end of the day, if I can't, I can always take it away, take a quick look, and reach back out to you, either through Kelsey or I'll give you contact information for myself, or have Kelsey do so as well if you have need for follow-up questions later. So without further ado, probably I'm just going to jump in. Like Kelsey said, please ask questions all the way through. If you don't understand anything, chances are someone else doesn't as well. There is no stupid question in tax. And I will caution you that a lot of the answers are, it depends, but I will give you all of the best information I can. All right. As Kelsey mentioned, I did work for BDO Canada for, I guess it was 9 years there, doing 9 tax seasons. So I've prepared a lot of personal tax returns at this point, and I'm always happy to help other people prepare their own. At the end of the day, hopefully this will provide you a good brief overview of preparing your taxes, and should give you a basis to try to do it yourself, and if not, enough information to be able to prepare to have someone else do them for you. All right. So the first thing I always get into is record keeping. All right. So record keeping becomes very important as you go to prepare and file your tax return. Canada Revenue Agency is the agency who administers taxes in Canada, and they require you to keep your records for 7 years. The reason for this is because due to kind of loss carrybacks and carry forwards and their ability to audit you for almost up to 4 years after you file your taxes, requires you to keep everything for 7 years. This is really important because at the end of the day, I've seen a lot of cases where Canada Revenue Agency will not allow you to claim your expenses if you don't have receipts. When I say this, with a bit of optimism that if you're missing a few receipts from the beginning of time when you were just getting started, you can still claim them. Don't not claim things just because you don't have a receipt. However, just go in with the knowledge that Canada Revenue Agency might deny you in that case. All right. So again, very important. You need to keep all of your receipts for all of your expenses. That's what people find to be the most important. But you also need invoices to back up the revenue you're claiming. And as I've got on the screen here in the third bullet point there, you really should be generating invoices or receipts that you keep a copy of as well for every one of your business interactions. It needs to include your business name. The invoice, it should have an invoice number, just that's more for tracking. It needs to have a description of the product or service you gave. And if you are HST registered, you do need to put the HST number on the invoice or receipt you give out. That is a very important requirement, especially for your customers in order to potentially get a credit for that HST. I have provided a link to a template here. I'm not going to open it or go through it. It's pretty straightforward, but it's just an Excel invoice online if you haven't already started generating your own invoices. When I look at some simple businesses, I see an ability to kind of just keep track of everything in Excel. I've definitely done that for a couple of friends who are starting up starting up their own business. As you grow, as your business becomes more complex, you're probably going to want to look into some type of software which will be able to automate a lot of your accounting needs for you, such as Simply Accounting or QuickBooks. I think Simply is called Sage 50 now. But at the end of the day, if you're just starting out, an Excel, keeping track of everything in Excel is definitely good enough for record keeping. All right. Some of the questions I often get on this are, do I need to have a physical copy of a receipt? The answer is no. Electronic copies of receipts are fine. However, one key thing to note is your credit card statement does not count as a receipt. It doesn't show what you bought, doesn't have any proof that it's business expense, doesn't give enough information other than it says you paid someone. So your credit card statement is not a receipt. All right. That's something I've had a number of clients kind of come back and say, hey, what gives? But want to give you guys that heads up right away. All right. I don't want to get too far into bookkeeping. I believe you guys have a bookkeeper coming in after me. So if there is any basic questions on bookkeeping, I mean, feel free to ask, but I'll leave that for the bookkeeping expert. Is there any questions on record keeping?
I got a question.
Yep.
Go ahead, Aaron.
Christine, you want to go first? Sorry. Oh, okay. So our company is based in our home. Can we write off our house expenses with as a company expense or a business expense, or no?
Absolutely, yes. And I'll get into a lot more details in the third section of my presentation for that. But yes, absolutely. Key point to note, though, that does mean you now need to keep the records for all of your house expenses as well, in order to end up claiming those. Christine, I think you had a question?
Yeah, nice meeting you.
Nice to meet you.
In the beginning, I'm seeing myself doing a lot of free work to build connection and build a clientele base. Am I supposed to provide some sort of invoice, although it's $0 involved, so I can have a reason for claiming my expense rather than showing nothing?
No, you won't be required to generate an invoice for nothing. Essentially, as long as you have kind of a business plan and a path to reasonable expectation of profit, you are definitely allowed to claim expenses before you start earning income. You just need to show that it's not just personal in nature for the expenses that you're acquiring. So as long as they're business expenses, that's still fine, and you don't need to do any extra work to show the free work.
Thank you.
No problem.
Chris?
I was just wondering, like, I'm kind of reading up about it now. I was trying to look it up. But so if you go you go do your taxes as a person and you make under a certain amount for the year, they give you money back. As a registered business, when you do your taxes, do they like give you money back, like personal tax at all?
So that is very dependent on your specific situation. So usually when you make under a certain amount, most of the amount you're getting back is generally going to be taxes that were deducted off your paycheck already, right? So it's taxes you gave the government, then found out you didn't need to pay, so they give it back to you. Right?
Okay, so it's not like where
you give them any money in the first place, chances are you're not going to get anything back. Now, you will qualify for, Trillium benefits potentially in Ontario, the GST credit. May or may not qualify for the working income tax benefit, which.
Oh, can you because like personally when I do my taxes, I get the Trillium benefit, like for personal tax I get all that, but can you get other, like a business tax, you get another Trillium on top, like more?
No. So are you incorporated?
No, actually I didn't register it yet. Like because I figured like I would just make my first sales first and then like get around to registering it, because it doesn't really, in my head I was like, it doesn't really like do anything with the registration, I guess.
Yeah, so you don't have a separate tax return for your business. You're just going to report your business income on your personal tax return. So I'll kind of get to that a little more in detail in a second, but there isn't a separate tax return totally.
Okay, thank you.
Oh, sorry, I had a question typed in here from
How much
Kelly.
money do you have to make before you claim taxes? Claim expenses.
Oh, so again, yeah, you don't need to have already started generating income in order to claim your expenses. What this does is it creates a business loss for the year. This loss can then either be deducted against other sources of income, or if you don't have any other income, then it can be carried forward to a future year to reduce future income. What you do need to have though is kind of some sort of proof if you get questioned at all that you actually have started a business and it's not just you know, a personal hobby. So for example, I have a friend who you know, did photos for a couple of his friends at weddings. He wasn't then able to go out and, you know, expense his camera and his travel and everything and create a business loss because he had no intention of making a business, right? If you've started a business and just haven't started making money, all of those expenses are claimable right at the beginning.
Suraj, you look like you had a question.
Yeah. Just to get back on Christine's point, Christine said that she was giving out like free consultations, which would, like, if that was a product, it would be like a sample, right? Like if you're giving out samples. So would that, can we claim that as a marketing or advertising expense?
Yes, you can. Again, as long as it's within reason, specific to the business, and you have an intended business model where you will show, the CRA calls it a reasonable expectation of profit, right? So if you're just, you know, buying up some goods and giving them out to your friends and, you know, you're not going to be able to claim that. But if you're starting a business, you get some upfront samples or you're giving out some free services to get your name out there, by all means, any related expenses are deductible.
Perfect.
I have a question for all of you. How many of you are actively tracking your expenses? Almost, okay, all of you, good, awesome.
I have another quick question.
That's true, that's true.
Go ahead, Omar.
Can anything be written off as a business expense?
We talked about this last night.
Kind of. Anything that is specifically business related can be written off as a business expense. Anything that has a personal nature to it, you need to either prorate or have a really good case as to why it is actually a business expense, right? There are some specific limitations in the act, like in the Income Tax Act. So like meals and entertainment, you can only write off half of them because the government says, you know, you're getting your own benefit by getting a meal, right? You're going to a sports game that's also enjoyable, so you can only claim half of that as an expense, right? There's certain other very specific limitations, but in general, any expense you incur for business only will then be able to be claimed as an expense for your business.
Okay, thank you so much.
No problem. And then did Jared have a question?
No, I think he was just saying that he
Oh,
keeps his
clapping or
records.
something?
Yeah, no, I don't have a question yet.
Oh, okay.
Jesse?
Just real quick, I didn't know if you covered this, but for voluntarily registering for your HST number.
Yep.
Did you already cover this?
I haven't, but I will cover it later.
All right, I'll wait.
Yeah.
So Kelly asks, what do I do for taxes as a Canadian running a business in a different country? Do you want to table that one for a little bit?
Yeah, so Kelly, we might have to, yeah, we'll address that at the end because it will definitely be a very specific question for you by the sounds of it, but it'll depend on your residency. LOL, that's a good one. Yeah, good point. Yeah, it depends on what your residency status is, but for the most part, you will be filing the same way everyone else is. You'll just be subject to some different rules. So we can chat about that at the end.
Cool.
All right.
Next question.
All right. Yeah. So no other record keeping expenses or questions? Oh, Aaron?
Sorry, I just have one more question. So let's just say, like, I bought a laptop off Kijiji to work on the business, but there was no actual receipt with it. Could I still write that off as a business expense?
So that's again my response from a practical perspective is definitely put it on your tax return. If CRA comes back and requests a receipt or something, you might not be able to provide it. They may deny it because one of the requirements to claim expenses is that you have proof of the expense, which generally is the form of a receipt or something. If you have enough email correspondence with the person on Kijiji or text messages, like that might be able to help your case. But yeah, technically you need to have a receipt, but still claim it. I always say that when you have an expense that was legitimately incurred and you just don't have a receipt, like they can't penalize you for trying to expense it. They can deny it because you don't meet the requirements, but we should be good. Cool.
Thank you.
No problem.
How far back can I go claiming expenses? Can I claim expenses from a business purchased in 2018?
That's kind of like my question too.
Yeah, so for that I have a technical answer and a practical answer. From a very technical perspective, what you would have to do is go back and amend your 2018 return. So file a T1 adjustment is what it's called, or if you are registered with the My Business account, or sorry, the My account with Canada Revenue Agency, you can do it through, I think it's called Change My Return. But at the end of the day, I will often see people just push the 2018 expenses through the 2019 tax return. Again, just knowing that if CRA audits you and they come across this, they may deny the expense in 2019, in which case you would still just go back and put it on, amend your 2018 return. Yeah, that's a practical approach versus technical approach for sure. Does that answer your question? Perfect. All right. So I think at this point we'll go on to our next section. I do want to kind of keep moving here, but again, keep the questions coming because they're, well, honestly, they've been great questions so far and definitely apply to basically everyone. So at the beginning, and what this next section is based on is the unincorporated business. So where you're either operating your business as a sole proprietor or as a partnership. If you're incorporated, again, a lot of these things do still apply, but there's definitely some significant differences. We can, if you have specific corporation questions later, by all means ask, but this is generally what you do on your personal income tax return.
Hang on.
Oh.
Is anybody incorporated? I don't. You guys have incorporated?
Like as a sole proprietor or dual proprietorship or incorporated?
Incorporated. So not a partnership, not a sole proprietorship.
Oh, no.
I think they all are one of those two things.
Perfect. Okay.
Oh, Charlene, you're incorporated?
Done it for modeling, like for myself as a model in America, and I have to do it here. I file HST, and you have to consider yourself like that when you do jobs like I do.
So are you an incorporated entity or are you a sole proprietor? You're an incorporated.
Incorporated in America.
Okay.
Oh, okay.
Neat. I didn't know that. Cool.
Yeah.
All right, there you go.
So again, totally different set of rules that I'm not really covering at this point, but if you have questions, feel free to lob them up. I'm not sure I'll be able to answer all of them on the US side, but I can definitely help with the Canadian tax side for you. Okay. So in that case, this will basically apply to everyone then. So for your business at this point in Canada, you have to use a calendar reporting period to report your income or losses on your tax return. So You used to be able to have an off-calendar fiscal period. You now have to have an annual fiscal period being January to December. All right. You report your business activities on it's called a T2125, 2125 form. It's part of the tax return. And when you do this online, it'll just be one of the other forms. If you do it on, I think I was looking at it on TurboTax most recently, and it's just called self-employment income. T2125 is the technical thing if you want to, Google the form, see what it looks like and whatnot. Essentially on that form, you're going to report your income statement. So you start with your total revenue, you enter your cost of goods sold, enter all of your expenses, and then enter any capital assets in. That will generate you a net income number, and that is the income number that you're going to pay tax on for your business. That income number then gets added to any other sources of income you have, any other deductions you've got on your return, to generate what your tax bill is going to be for the year. All right. For the most part, when you have a business expense, you write it off in the current year as long as it's something that you would use in the current year, right? So if you have any, office supplies, paper, pens, if you have any interest you're paying on any loans, if you've got advertising expenses, meals and entertainment expenses, all that kind of thing, they're just written off in the current year. When I say they're written off, they're used to reduce your revenue to get to your net income or your taxable income. All right. There's a few exceptions to that. And the first one I really want to get into is capital assets. So when you buy an asset that is used for multiple years, so this would be furniture, equipment, your computers. Honestly, these days, probably cell phones might even fall into this. Anything that, is going to be used over a significant period of time, it will still have value at the end of the year you purchased and used it. This is what we call a capital asset. So for capital assets, you do not expense it all in one year. Okay. Really common one I usually include in this is also your vehicle. So if you purchase a vehicle, it will be a capital assets, and you write it off over multiple years. There are predetermined classes of assets. For example, a computer you write off at 55% a year, right? So you write off more than half of it in the first year, then 55% of what's left the next year. It's a declining balance, so you keep writing off a percentage, so it just keeps getting smaller and never quite fully goes away. So computers are going to be at 55%. They're one of the faster ones. Vehicle, you write off at 30% a year. Furniture, fixtures, general equipment is 20% a year. In the first year, you only get to write off half of what you normally do, which just says, on average, you would buy the assets halfway through the year and use it for half a year. It's a weird rule that it has some basis, but always kind of catches some people off guard. I've included a link in this Word document in order to send you just to the list of classes, so that if you're actually preparing your return yourself, you can go there, and it's a relatively extensive list. If you don't find your asset on that list, just Google it and call it capital asset classes tax, and usually it comes up. Honestly, that's the first thing I did every time a client had an asset I didn't know what it was. I would Google it. I would then research and make sure that my search provided the correct answer. But Google is your friend in this case. Does anyone have any questions on capital assets? I know they can be kind of confusing, but the program and whatever online service you use to do your taxes is pretty good at it, as long as you know where to add it. No? Okay. Okay. So next, I just kind of go into some of the general tax rates. I created a link to it's a website called Tax Tips that shows you what your graduated rate is based on your income level. So For example, if you're earning, honestly, I guess that number is kind of outdated. I think it's up to 44,000 now. Your tax rate is 20%. After, I think it's 50,000 now, it goes up to 31%. Somewhere around 90, it hits around 43%. So it goes up significantly as you get more and more taxable income. When I say it's a graduated rate, what that means is your first 40,000 of income, no matter what tax bracket you get to, right? If you have 100,000 of income or you have 40,000 of income, the first 40,000 is taxed at 20%, right? The next 5,000 is taxed at another 24%, right? I think I saw a hand up for question there, Jesse.
Is that percentage, like if my business makes $40,000, or if I take $40,000 in income from my business?
That's what your business makes. So as an unincorporated person,
Wow,
you're taxed on the business income at the time your business makes it.
that is terrible. So spend like $1,000, get incorporated, and go deal with it that way.
Potentially, but if you so I'll get to the corporation stuff in just a second.
Sorry.
There is a little bit more to it than that. But yeah, if there's any other questions on the general personal rates though, I'll take those first. Okay. So as I've listed in the last point here, the corporate small business rate currently in Ontario is 12.2%. All right. So that means that when you earn the income in the year you earn it, you're going to pay tax at only 12.2%. However, if you then take the money out of the business, you then pay personal tax on dividends, which is slightly different rates, and ends up working out to almost exactly the same as if you were not incorporated. So for example, if your business made 40,000 and you were not incorporated, so you earn this personally, right? You would pay, what would that be? $8,000 in tax, okay? If you incorporated your business on that 40,000, you would only pay $4,800 in tax. However, if you took the remaining 35,000 and change out of the business to pay all your personal expenses, your rent, your hydro, etc., right? You would pay the remaining 3,400, I guess, in the example, so that would work out to the exact same amount, almost. It's never perfect, but in Ontario right now, it's so close that I say it's the same, right? Where incorporation will really help you is if you're keeping the money in the business, right? So if you're growing, you're buying more equipment for the business, you're getting more inventory on hand, you're having a lot of like capital expenditures that you can't expense right away. If you've taken on a lot of debt and you need to make the principal payment on that debt, incorporation can help you. But I just want to point out it's a deferral, right? So eventually when you take that money out of the business, you still pay the tax on the dividend that would be the same. What is happening though is you don't pay that 3,500 till you take the money out, right? So if in this first year you use the money to pay down a loan, right? You've now had an absolute tax savings for now that you'll now, when you make the money again in the future, take out and pay the personal tax. So overall, like you can't just look at it as, oh, the rate is smaller, because if you take the money out, you're not actually saving anything, and then now you've just got extra costs to run a corporation. Jesse?
So if you said if you pay the money from the business to a loan, is a line of credit a loan?
It is, but if you have the loan, so this is where like the loan would also need to be inside the corporation, right?
Yeah.
So
Okay.
if you have a personal line of credit, you're still going to take the money out to pay off the credit personally, in which case you're getting taxed when you take the money out still.
Okay. But if you had a corporate line of credit, then that would technically be under the business, and that would be a loan. And
yeah.
Okay. Interesting. Okay.
Kind of think of a corporation as a box around your business, right? Anything that is specific to you personally is outside that box. So if you're making payments outside, you need to take the money out. That's where the tax happens, right? If you
Understood.
get inside the box, then it's inside the corporation and you don't have to pay the personal tax yet. All right, cool. The other piece to note, as we've kind of alluded to already, is if you're losing money in the business during the startup phase, which is obviously very typical, you can apply that loss to reduce the tax on your other sources of income. So as an individual, how this works is you've got your business income, all of your other income, you add that together to figure out what your tax is, right? So if you've made 30,000, a day job, right? And you lost 15,000 in your business this year because you're just getting up and running, you only pay tax on that 15,000 net, not the 30 originally, and keep that loss, right? So there is benefits to not being incorporated right away. Just as a thought, right? Once you become profitable, especially when you get up into higher tax rates, and especially when you're not relying on all of your business income in order to pay your personal lifestyle expenses, that's where you start seeing a lot more benefits from incorporating. Next point, so your tax return when you're self-employed actually it's due later in the year to kind of give you more time to figure out your business income. However, you still actually have to pay by April 30th like everyone else. So it's kind of weird that way, that they give you extra time to file, but you still owe them back in April. What that means is you can just do a quick estimate, right, without preparing and filing your return before April in order to figure out what you need to pay. But you don't have to file until June 15th. Okay. Now in our wonderful COVID year now, your due date would have been June 15th, but I think you have until September 1st. No, they extended it again, didn't they?
I think it is.
Yeah, I think you have until September 30th now to make any payments for your 2019 tax return. I don't anticipate that being the same for next year, so be prepared to pay any taxes by April 30th. All right. The next point is really a bit of a money management strategy thing that some business owners, when they first start, aren't aware of. So you really want to plan for this part. When you're self-employed as a business, right, you don't have an employer taking an income tax deduction off your paycheck every week, right? So at the end of the year, if you're profitable in that first year, or in any first year you become profitable, you've not made any installment payments, you haven't put any money down on your income taxes, right? So when you get to the end of the year, you're going to have a big balance owing in April 30th that some people don't prepare for. What I would suggest is, as you realize you're becoming profitable, when you check your income year to date, some point during the year when you're managing your business income, right, start putting away some savings in order to prepare for that. After you get past that first year, CRA will start telling you need to make installments, right? So because you don't have an employer taking money off your paycheck, they're going to say, now as a business owner, you need to send us money throughout the year based on one of three methods, but the most common is whatever your tax was last year. Okay, so they'll require you to make an installment every March, June, September, and December, I believe, and then with any further balance owing in April. If you don't make those installments, they'll charge you interest because that's money you should have paid them already, right? But in general, in that first year you become profitable, you're definitely going to owe money on your tax return, right? So be prepared for that. And if your income keeps going up, like if your income in year 3 is higher than year 2, the installments won't be enough. So you're still going to have a balance owing in April, right? So just be prepared for that. I would suggest maybe looking at that tax tips website to say, okay, I've made less than 40,000, so I should just keep aside 20%, right? Oh, now I've made 60,000, I need to keep more than 20%, right? Because you're in the 30% tax bracket, right? So you can do a bit of calculation on your own, or just there's some calculators online. Tax Tips actually has a good calculator where you just plug in what you've made so far, and it tells you what your taxes would be. So those are just heads up to avoid a cash crunch when April comes. All right. The other thing that many people, including myself for a while, didn't realize was you still have to pay CPP on your self-employment income, right? So again, this is based on your net income. So if you're not profitable, you won't have to pay CPP. But once you become profitable, you have to pay both the employer portion and the employee portion of CPP. As of the last time I was doing tax returns, that would have been 9.9% of your net income in CPP. I believe it's maybe 10.1 or 10.2 now. It's going up. But yeah, so that's another kind of heads up that there's on top of the tax that you have to pay on your net income, you also have to pay CPP. Now you get to take a deduction or an expense for the employer portion, right? And you get a personal tax credit at 15% for the employee portion, as if you were an employee. But at the end of the day, just be aware that that's going to be another cash crunch in April when you file your return. All right. So overall, any questions on how you will generally pay taxes on your personal income tax returns or self-employment CPP?
So it like works out to almost, there are like deductions and stuff, but it's almost like 30% or more of your generally what your business brings in at that initial tax rate.
Yeah.
Damn.
Now, so this is all excluding. So there's always your basic personal tax credit, which means that I think it's your first 12,000 or so is basically tax free, right? So they charge you 20% tax and they give you a credit for 20% as well, right? And that's always there. Then you'll get, like I said, on the CPP, you get a tax deduction. So then you save, what would that be? That would be 20% of the 10%. So you save a couple percentage points there. You get a credit for the employee portion. So you save another 15 or 20% of half of the CPP, right? So it probably is closer to maybe 25, 26, but yeah, and again, this is all based on profit, right? So you can make 100,000 in revenue, have 90,000 of expenses. You're only paying tax on the $10,000 net income, right? So it's not based on the top line, which, yeah, really it's cash in your pocket at the end of the day.
I have a question. Oh. Go ahead. Go ahead, Aaron.
Can you give yourself a salary as a sole proprietor?
No. So as a sole proprietor, and honestly, like if you think of the mechanics of it, as a sole proprietor, you would be paying yourself a salary. So you would deduct the salary from your business income and then include it in your personal income, which nets to exactly zero from a tax perspective anyways. However, they specifically disallow you paying yourself a salary as a sole proprietor.
What about a dual proprietor?
So as a partnership, it's the same, basically the same. You still can't pay yourself a salary as a partner. Now you can have an agreement that says, one partner who does, 100% of the work gets to take, X amount of dollars out of the profit first, and then we split the rest, right? But it's specifically not a salary. It's not an employment income. You'll both be taxed on your proportionate share of the of the net income of the business, right? So for example, if your business is a perfect 50-50 partnership, right? If your business has net income of 20,000, you're each going to pay tax on 10,000, right? If you decide that partner A for doing more work takes the first 15,000, and then we split the rest, right? Partner A will pay tax on that 15 he gets first plus half of the 5, so 17,500. The partner who just gets 2,500 only pays tax on that portion, right? But yeah, overall, there's no way to include a salary as part of this.
Okay, awesome. Thank you.
No problem.
What's the mechanism for setting up paying CPP?
So the CPP on self-employment income is an automatic calculation on your tax return.
Oh, so you do it on your taxes?
Yeah.
Cool.
Yeah, you do nothing special, it just goes as part of your tax return.
Cool, thank you.
No problem.
I have a question. So if say your expenses are more than your income, does that then cancel it out and you don't have to pay tax?
Correct. Yep.
Oh, okay.
Yep. So yeah, so if you're losing money, so if you have a net loss, right?
Yeah.
They're not going to tax you on that, and you don't pay CPP on that. In order to claim that loss, again, what I was saying before, you do have to have a reasonable expectation of profit. So you do have to have a business plan in place that shows I should be profitable if I succeed on my business plan, right? You don't necessarily have to actually ever succeed, but you have to be able to expect that you can. And then that loss can either save you money on your other source of income, right? So it'll reduce your total income for the year. And if you have no other source of income, you carry that loss forward to deduct it in the future as kind of another expense, if you will.
Okay. Thank you.
No problem. Suraj?
Just to make sure, how many years can you carry forward that loss?
So you can carry a loss back for 3 years, and I believe it's forward for 20 now.
All right, perfect. Yeah, number just ran out of my head. I thought that might as well remember it right now.
Yep.
Thank you.
No problem. Any other questions? Okay. So now I will move on to one of those previous questions, which is the business use of your home. All right, so this is a common expense for the sole proprietor. Most sole proprietors will end up working out of their house. There is some basic requirements that need to be met for the business use of your home. Specifically, it needs to either primarily be the space that you operate your business from, or it needs to be the space that you primarily meet clients at. Okay, so at the end of the day, I do know a lot of people will claim just a home office expense, even if they're just doing the office portion of the business in their house. That is potentially a risk, but again, from a practical perspective, if your office is primarily just used for your business, you can kind of treat it as a business space. Just be aware there's a slight risk if you've got an offsite place that you operate your business out of, and there's an office there, right? The fact that you just decide to do a little bit of work at home too doesn't make your office a home office expense. If you do all your work out of your home office, especially for software companies or online companies, right? That's your primary business place, and you can definitely write off all of the expenses related to that space. Okay. There's two potential ways to calculate what percentage of your home expenses you can claim. Okay. The first and the most common way is based on square footage. Okay. So if your house or apartment or condo or whatever it is 1,000 square feet, and your office that you operate out of is 200 square feet, you can now claim 20% of your expenses for the business. Okay. These don't need to be paid from a business account or anything like that, right? You'd still incur them normally from your house, but you get to expense them for tax purposes. All right. The second technical calculation is you can actually do it based on number of rooms. So this can potentially be advantageous in, a 2-bedroom condo where you're using 1 bedroom, like the small bedroom, as your office, right? So if there's 3 rooms, your open living room, kitchen, dining room area, and 2 bedrooms, you can now claim 1/3 instead of that small square footage that second bedroom is. Just again, that you got to make sure that then that second bedroom isn't also used for personal reasons all the time, right? So again, the space needs to primarily be for business use. If you have a mixed use area, so if you've got an office in a bedroom that you use, if you just got a 1 bedroom and you've got your office set up in the same bedroom, right? Then you've got to kind of prorate it based on the amount of time you use it personally versus business. So like that's a second percentage, right? So it gets pretty small in that case, but that's the general gist of the home office. The expenses you can claim are all of your general expenses for the house. So your heat, your hydro, your insurance. If you own your home, your mortgage interest, just the interest specifically, not the principal portion. Okay, the principal is just paying back a loan. The interest is an expense, right? If you're in a condo fees count. If you're renting, your rent counts. If you do repairs and maintenance, that can also count, especially when it's relative to the whole house. I think actually some people will also say water counts as well. You got to be able to go wash your hands, go to the washroom. You can't claim your bathroom as a business use place unless your clients are specifically using the washroom. So if you've got, if you actually have clients coming into your house for, say, to receive services, right? If they wait out in the front foyer, that now is a business area, right? If they you have to have a washroom available to them. So that single washroom now counts, right? When it's just you working in your office, the washroom is a lot harder of a sell. You can't really count that one. All right. Again, these home office expenses that you're prorating are the general house expenses. If you have something that is specifically attributable to the business, so if you got a separate phone line for the business only, right? If you got if you got a better internet package, if you got internet for the first time in order to run your business, right? If that internet is 100% business use, you can claim the entire expense. If it's, say 75% business use for the internet, you don't have to prorate the internet the same way you do the rest of the house. Okay. Anything that is business specific is a full business write-off. Okay. All right. Any questions on the business use of your house?
Would the CRA send someone to verify the space you're using?
Yeah, like because I use my garage for storing bottles and I use my basement as an office. Like who's coming to check my square footage?
So in general in Canada, you've got a self-reporting system, right?
Yeah.
So as you file your tax return, you put on it whatever you put on it. In the last audit I've seen, they actually ask you to submit a floor plan of your home.
Okay.
And then show what the business use area is. And then I believe if they're at the level where they say, no, this is unreasonable, you can't possibly be taking that expense, they may send an auditor out.
Understood.
Right.
Thank you.
So do they also base it off of square feet as well?
Like if an auditor came out, you mean?
Yeah, like if you have to send in like a floor plan of your home?
Yeah,
square footage or number of rooms.
That would be to support the number of rooms for business use or the square footage you're claiming for business use, right? So you would submit the floor plan, you'd say this room is so big, that's how many square feet, this room is so big, or this is one room that's personal, this is one room that's business, right? So this is just, again, if you're being audited, you don't send this with your tax return all the time. It's if they're asking you questions about your business use of home that they request that you send these.
Okay, thank you so much.
No problem. All right, any other questions? Nope. All right. I don't actually have a prepared slide, but kind of similar to the business use of home. You also have your business use of automobile. So if you are using your personally owned car for business use, or if you've bought a new vehicle for business use, you can also claim the vehicle expenses. All right. If you have a vehicle that is 100% business use, or they actually use the phrase in the Tax Act that's all or substantially all, which means more than 90% of the vehicle is used for business purposes, you can write off all of the expenses relative to that vehicle. Okay. You will still need the mileage log that I'll talk about in a second, but that makes a vehicle 100% business related if it's more than 90. Okay. If you have a vehicle that you use as your general everyday vehicle and you also use it sometimes for business, you can claim a percentage of all of your automobile expenses. Okay. In that case, it's always based on kilometers driven. Okay. So what you need to do is you need to keep a mileage log to support your business use of your vehicle. I believe it's actually one generated by the CRA online that you can look up. If it's not by the CRA, there's plenty online available. But essentially what you need to do is you start recording at the beginning of the year what your odometer says, right? Then you say, okay, I did this business trip delivering to clients. It was 70 kilometers. You put that in your book on this date, right? Next day, oh, I went and picked up inventory from, this place. It's 5 kilometers, right? You total up your number of kilometers, take your closing odometer to figure out what the total was, and do a percentage. A lot of people will say, can I just simplify this and say, oh, I probably drove my car 20% or 50 or 72%, right? Again, the practical answer is sure, but if you get audited, you're going to be in trouble, right? CRA specifically says that in order to claim automobile expenses, you have to have a business use log, unless you are making the claim that it's 100% business use, right? If you're in that 90-92% range, you probably still want a log to back up your claim that it's almost all business use, right? So my buddy who started a IT electrician type business, he bought a separate van, right? So it's got all his tools in it all the time. It's the only thing he does is drive it to job sites and back, or for inventory pickup and back. He's got a separate vehicle that he uses to go to the grocery store, right? That's really simple. He doesn't keep a log because that van is just a business van. If you don't have another vehicle, it's going to be, the person auditing you is going to say, well, if you don't have another vehicle, how do you go to the grocery store? Oh, well, I just take the work truck, right? And then you run into trouble. So that's when you really want to be able to rely on that mileage log. And if you're anywhere under the 90%, they definitely are going to want a log if they audit your expenses. Okay. I've had a number of clients that, said, I'm not tracking that, put this percentage on our return. We did. They got an audit. Their whole automobile expense got denied because they didn't have the log, right? Key point to remember is the drive from your house to your warehouse or your office or anything that's off-site is a personal drive, right? When you're getting from your house to work, that's personal. Okay. So some people, I've had a couple clients who actually get dinged for that. They have a 20-kilometer drive into the office and a 10-kilometer drive to the parts store that they were driving to, right? All of a sudden, that's only 1/3 business use, right? So you do have to watch out for that. I say this pretty strongly because CRA in recent years has started auditing a lot more automobile expense claims, and specifically for business owners and corporations where the shareholder has a vehicle in the company. So you kind of it's one you really want to pay attention to. For the current year, if this is the first time you're hearing about this and you haven't started an automobile log and you say, I've been driving my car a lot for business, feel free to expense that, just again with the knowledge that if CRA asks, you might have that expense denied. However, I would suggest really starting an auto log. A lot of people just keep like little, the little like notebooks or diary books in the glove box. And when they get in the car for a business drive, write it down, right? That's the best way to do it. I've seen some people kind of go back after the fact, and it's a little harder to piece back together, but.
That was kind of where I was going to just interject. Yeah, if we had to backtrack a bit, so, based on for example, me, my clients, or places that I've dropped sauce off to or gone to pick up product or whatever, based on dates and stuff like that, I could at least add those sections of kilometers. And as long as I have a log of that, that should be acceptable.
Yeah, definitely feel free to go back and create the log that for stuff you did, right?
It's just a pain kind of thing.
Because it could backfire, but yeah, for reasonable stuff like that, definitely go back and recreate the log as far back as you can. And if you have a period where you just so if you're doing stuff at January to August at this point, right, and you can't spend the time, just do from August to December, apply the same percentage, right, as an estimate. That's a bit of a shortcut if you don't want to spend hours like poring over receipts to say, oh, when did I go there? When did I go here? Again, that's actually recreating the log would be a much better form of defense. And again, this kind of only matters if you get audited, but they're looking at a lot more of these, so be prepared. Okay, so I have a question. Aaron.
So I've got a question. So when you're driving from your home to your business, that doesn't count as an expense, right? It's a personal expense, right?
Correct.
So what if you were to just slap on your logo on the vehicle and just call it a marketing expense?
You can deduct the logo as a marketing expense, but driving the car does not become a business expense just because you got a logo on it.
Okay.
Yeah, so still the drive from home to the business is personal. And a lot of people try that actually.
Oh, really?
Got denied in a lot of cases. So good thought.
How does a car loan work?
So a car loan, similar to a mortgage, you've got a principal portion and an interest portion, right? The principal portion is just repaying a loan, so that is not an expense, okay? The interest portion is an expense. I believe there's a limitation on the interest expense you can claim, which indirectly is to prevent you from, getting a loan for a crazy high-end, Lamborghini, whatever, and trying to expense that for business purposes. So it's like $10 a day, which is $3,650 of interest in a year. At today's interest rates, it's pretty hard to hit that on a reasonable vehicle. So you basically get to write off all of your interest. As we talked with the capital assets, how you can write off a vehicle over a number of years if you buy a business purpose vehicle. When you have a personal vehicle, you can do the same thing, and that depreciation is again prorated based on number of kilometers driven. Right? So then the principal portion of the loan you're not deducting, but the original cost of the car that the loan is for, you do get to deduct as capital cost allowance, which is the tax word for depreciation. All right.
Cool.
Good stuff. All right. So that's kind of your business use of home, business use of automobile. All of the other expenses need to be business based, right? I covered a couple of things. So like your meals and entertainment are only half deductible. In addition, there's you can't claim a deduction for interest and penalties on your tax return. There's a few other minor changes and limitations. So if you're leasing an automobile, there's a maximum deduction of, I think it's $800 a month plus tax. Yeah, a bunch of the other kind of changes are going to be very specific to a specific client situation. So I don't want to go through everything. Yeah, all right. So at this point, I will move on to everyone's favorite topic, which is HST. So as I'm sure everyone has heard and researched and been told multiple times, you have to register and start charging HST when you exceed 30,000 in sales over the previous 4 calendar quarters. So I want to kind of dig in on this because it's something that everyone always says, 30,000 in a year, right? But it's specifically the previous 4 calendar quarters, or if you run into it in the middle of a quarter for that quarter alone, okay? Why I'm being very specific on this, right, is if I start my business in June and I have 10,000 in sales for between June and September, and another 10,000 in sales from October to December, and then 11,000 in sales from January to March, right? That is now past 30,000 in the previous 4 quarters, even though in the previous year I did 20,000, and in the current year I'm only at 12, right? You've still hit 32,000 in 3 quarters, okay? That means that as of, I believe it's 1 month, like you get 30 days to register, right? But as soon as you hit, in my example, April 1st, you now need to be registered for HST and start charging it, okay? So again, it's based on the previous 4 calendar quarters and not a calendar year, all right? The other point where you might need to register sooner is if you hit $30,000 in a single calendar quarter, right? So if I did, my 10 in January or 10 or 20 in year 1, but then in January alone, my business has taken off and I get 30,000 in sales in January alone, you have to register and start charging HST as soon as you hit that $30,000 mark in that quarter. Okay, so that's kind of like a speed registration because you just took off, but that one's also very important and not a lot of people talk about that one.
We would say that in like seasonal businesses probably, right?
Yep, seasonal businesses or a new business that just takes off with high dollar value sales. And again, this 30,000 is in your top line, right? So that's revenue, sales, whatever you want to call it, not your profit, right? So you can have 30,000 in sales and 35 in expenses and have no net income. You still have to register for HST when you get that 30,000 in sales at the top line. All right. Now I say HST for Ontario. For what I believe most of your businesses will be, you'll be providing your services in Ontario, in which case it's the 13% HST. However, and I can't get into this in a ton of details, I'm not an indirect tax specialist, but you have to charge the sales tax based on where your sales are performed, okay? So if I'm selling my goods in another province, I have to consider what the tax implications are in that province. One way to be specific about this is if you're shipping to a customer in another province, but the transition of ownership happens in Ontario. So that is, I forget what it's called, I think it's freight on board shipping. You've done the sale in Ontario, even though your customer is from out of province, right? If you are doing a service though, I know as a public accountant, when we did services for people in the States, we did not charge them HST because it was based on their location where they were receiving the service, right? So there's a lot of complicated rules when it comes into like interprovincial and international sales. So you want to make sure you either get I believe Shopify actually has something where they try to do this for you. or consider looking into, talking to a public accountant that is a tax specialist within BDO. We had specific people in specific offices that specialized in this because there's a lot of complicated rules at the end of the day. Whereas if you're just very simply doing all your business in one province, it's very easy. It's just going to be your 13% HST on your sale. Okay. If you provide a discount, that would be before HST is charged. So if, for example, you are providing a service or a good that costs $1,000, and it's a bulk purchase, so you're offering a 10% discount, then the price you're actually selling at is $900, and that's what the HST applies on. So you don't have to collect the HST on the 1,000 and then give them the 10% discount after that, right? You do the discounting first on sales, okay? But it does definitely apply to the sale. Like, you don't adjust for expenses that go into it or anything like that. So do you have any kind of questions on that top line? I'll get to the tax credits you can get for HST in a minute, but does anyone have any questions on
I have
the
a
top
question.
line?
Yeah, like, so when you go and pay, like, at a store, you pay your 13% tax, and so as a business owner, you would charge them like your amount plus the tax on top, and then you would like keep the tax like in a savings and then give it to the government.
Yes. Yeah. So if I understand the question, so you're going to sell the store your good, and you're
Yeah,
gonna,
like say my small collar, it's like $22, and then I would do like one like times that by 1.13, charge the customer the tax, and then I would take the money for myself, and then the tax I would put in like a tax savings account.
Yeah. So I guess, basically, so your HST is an annual filing until you hit sales of I think it's $1.5 million. So you can be an annual filer for quite some time, but definitely want to save your net HST. Keep track of that, because when you go to file the return, so again, it's the same filing deadlines as a tax return. Okay, so it's due on June 15th. It's a separate, I think it's called a GST 34, but it's your HST filer, right? You file it by June. You have to pay the HST by April of the following year. Okay, so definitely it's a good idea to put aside the HST you collect. Now the caveat there is, once you are registered for HST and you are starting to charge HST, right? You also then get an investment tax credit, they call it ITC, for all the HST that you pay. Okay. So for a quick example, if I buy a good for $50 and I pay HST on that, which would be, I think it's $5.65. And then if I sell the good for $100 and I collect HST, which would be $13, I did the math wrong there. $6.50 would be the HST you paid. It'll be half, right? When you go to file your return, you have to give the government the $13 you collected, but they're going to give you back the $6.50 that you paid when buying the goods, right? So that your net payment to the government is just the $6.50.
Okay.
So what that really means is, as you're doing your bookkeeping throughout the year, you've got two separate accounts, right? So when I do the sale for $100, right, I'm going to put $113 in my bank account.
Yeah.
Record $100 as a sale, and then I'm going to record that $13 as HST I collected. Okay.
Okay.
Another account called HST paid. So when you go out and you pay the $50 or the $56.50, right, you're going to expense the $50. You're going to put the $6.50 in the HST paid, and it's just those two accounts on a net basis that you really want to be saving for. That's the payment that's going to come out in April to the government.
Okay.
Right? So if you monitor that as you go, like, you don't really have to put 100% of the collected HST away in savings the whole year. and then find out, oh, I actually had all these ITCs. I now only have to pay part of this account out, and I could have spent the rest of this money by now, right? If you're not watching that all year, it might not be a bad idea to save all the HST you collect and then figure it out at the end of the year, right?
Yeah.
But if you're doing your bookkeeping all year long, you can kind of keep up to date on how much you're gonna owe.
Okay.
Seems very
Yeah,
complicated.
it's like I think I'm just gonna try to save all the HST because it seems like it's just a lot to keep track of. Now
That's fair.
going through this
So
presentation. Yeah.
That's the conservative cash flow approach. I like it. And
Yeah.
then at the end of the day, you're forcing yourself to save money. So, you know, force savings.
Our
All of a
favorite.
sudden in April, you're gonna have a bunch of money left over. So
Sure.
good news.
Awesome.
Jesse.
So about the HST after 30K. So I've incurred a bunch of expenses buying inventory, laptop, car, a bunch of shit for my business, but I have not registered for my HST, my stuff, bunch of stuff, good stuff too, for my business. Now, I called the CRA in regards to voluntarily registering for my HST number. I was charging HST last year around August before my official launch. What they basically said was that I need to write a letter, have my logs, all my paperwork in order, proof basically that I've consistently been charging HST since last August. Now, I don't know if this is a question to take offline or whatever, but like, I don't really even know would I send that type of letter to the CRA, or who do I even really ask for permission to go back that far? Or is it worth it depending on how much expenses I have?
So you actually, so by charging HST off out the gate, and I'm assuming you specifically put this HST on the invoices you gave your customers.
Yeah. So it was all through, like, some of it was through Square around February, and then before that it was all cash deals. So there wasn't really, I have like a spreadsheet of it, but that's about it.
Yeah. So if you were charging HST, it's no longer actually voluntary. You must go back to the day that you started charging and register to that point. CRA agents are sometimes very, very helpful and sometimes not helpful at all. So you don't have the voluntary option anymore. What I would suggest is, I believe it's called the GST1 or HST1, and it's a form to register for HST. Alternatively, you know what? Do you have a business number yet?
Yeah, master business license number.
No, a business number with the CRA. It'll be a 9-digit number, and then.
Yeah, I do. When I called that time was actually to get my business number, because I couldn't find my business number with them. That's not my HST number though, is it?
It kind of.
So
when you set up a business number with the Canada Revenue Agency, that's not the same as your business license number. Okay.
No.
Your business number with CRA is a specific 9-digit number.
Yep.
That then has multiple what we call program accounts. Okay. So your business number will be the 9 numbers, and then it will say something like RT0001. That's going to be your HST number. Okay. If you incorporate with a business, it would say RC001. If you have a payroll account, it's RP0001, but that 9-digit number is your business number with CRA.
Okay.
If you have that, you can now have the option to do this electronically, potentially. If you set up a My Business account with the Canada Revenue Agency, then within that, there's the ability to figure out whether they actually gave you a GST number, or whether they just gave you a general business number that you need to start the program accounts for. If you have to,
I can look into that.
If you have to paper file this, you would get, which you might have to just due to the significant backdating of your registration.
Yeah.
You would file a form. It'll be GST1 or HST1, and
Yep.
on that form, it will tell you where to send it.
Okay.
It'll be your either your tax service office or your tax center. I can't remember which one.
Okay.
But it's one of those two that you send this kind of stuff to. Or you
A
might be
good
able
place to start would be my business account on CRA, see if I have that number, look for that form, fill it out, hand in my documents.
Yep, exactly.
Cool.
You have 15 minutes.
Okay.
Sorry.
So 15 minutes, but we're still I basically just have general questions at this point, unless anyone, so Kelsey, I think was saying no one has like formal employees at this point. So there is, I got a little section here on employment tax that basically just says, once you've got employees, you've got to file T4s for them. You've got to withhold CPP, EI, and income tax from their paychecks. You've got to register your business number with the CRA for a payroll account. And then you have to start paying all these withholdings to the CRA by the 15th of the following month. They'll tell you if you need to change that schedule at all, but it's pretty high by the time you need to change it. If they leave, you have to do the record of employment, all that kind of stuff. And I've just provided a link for how to calculate what you've got to withhold from paychecks and how to get a payroll number, which incidentally, Jesse, maybe look at that same link for how to get a GST number, because it's just registering a business number in general. So that same link should potentially help you. But yeah, so if you have questions on employment tax, feel free to ask them. But my understanding is there's no one in this boat, so I won't spend a lot of time on it. So at this point, Suraj, yeah.
I have a question about the second last point of the employment tax. Must file T4 for all employees for which deductions were taken or that were paid more than $500. So if anyone is paid less than $500, they don't really need to issue a T4.
So this is an annual number, right? That's my first comment, right? So it's 500 for the year, not 500 for a paycheck. The second point on that is if you have a formal employee, right, you probably have to take deductions even on the first dollar they earn, right? So if you anticipate they're going to only earn less than 500, they're under the CPP exemption level, but you probably still have to withhold EI. There's no minimum threshold there. So if you have a formal employee, as much as this $500 exemption helps, you probably have to take deductions on some of the first dollars anyway. So you might fall into this boat. At that point, if they're being paid less than 500 for a year, you can look at the question of, are they really an employee, right? If they're just a contractor who helped you out for a day, right? If you're giving your buddy a couple $100 in cash because he did some data entry or bookkeeping for you, right? They're not an employee. So you get out of this because they're not an employee, and that 500 threshold doesn't matter. But if you've got a formal employee, you're very likely to fall into this boat and need to do deductions and such properly.
Yeah. Thank you.
No problem.
I just have a question. So like this, yeah, freelancers, manufacturers, all this stuff, like that's separate from this. Like they don't, if you, for example, actually, yeah. If you're I'm doing dog collars. So if I'm working with a manufacturer, say I make an order of like a lot, like more than 500, they're not technically an employee. They're just like a separate entity.
Correct. Yeah. So if they're running their own business,
yeah,
and you're getting your product from them, they're not an employee, right?
Oh, okay, perfect. Okay, sounds good.
The employee test is incredibly detailed. There's 6 different kind of tests you look at, but in general, if you're just buying product off someone and they're doing their own thing and they're going to give you a bunch of product, right? They're not an employee. If you hire someone as an employee, you say, hey, I'm going to employ you to make so many dog collars a month and I'm going to pay you on this regular hourly basis. Right now they're an employee.
True. Yeah, like you're in-house like employees.
Right.
Yeah. Okay.
Yeah. If you're just paying a outside manufacturer. They're doing their own thing. It's all good.
Okay, perfect. Thanks.
Yeah, there's a fine line between employee and independent contractor, which there is a risk on you because you're liable for the withholdings, whether you took them off their pay or not. But at the end of the day, if you're not employing someone, that should be mostly a straightforward test, right? A lot of it has to do with control, right? If you're saying you need to be here between 9 and 5 every day, I'm going to pay you this much an hour, they're probably an employee, right? If you say, build me a website, hopefully it's done by June 15th, because that's when you say it can be done, that's an independent contractor, right? Yeah. So is there any further questions?
Karen has a question.
Aaron?
I got a question because there's this new loan for COVID for small businesses that they will give you up to a $40,000 loan without any interest on it, so long as you pay it back before December 2022. And if you pay it the full amount before that time, you can actually keep $10,000. I was wondering how to so one thing is the estimate is as long as you have a non-deferrable expense between 40,000 and 1.5 million, you can apply for it.
Yeah.
Could we potentially write down Google Ads as a non-deferrable expense and say that we're going to pay $40,000 in Google Ads, or no?
Are you going to do the ads, or are you going to pay 40,000 and then use the ads later?
Well, we're trying to find a loan so that we can actually start marketing our application. So we're not sure. So we're looking to get a funding to actually do this.
Yeah, so I haven't looked in detail at those specific loans. I would definitely look, because I think there was I know with some of the original loans for this purpose, you actually had to have salaries as well. So if you don't have an employees, you might not qualify. So definitely check that if that's still a qualification on this specific loan. The non-deferrable expense, I mean, that's where you got to start looking into, are you prepaying 40,000 of ads, or is it actually cost, like if you were to go to typically if you were going to hire Google Ads today to run ads for the next short period, is that going to cost you 40 grand on its own? And then with respect to that application, I believe they should generally define non-deferrable expense, right? So in my mind, to a certain extent, I mean, you don't necessarily have to advertise today, so they might lump you into that. Whereas if you look at it the other way of, I need to get my advertising out to get my business off the ground, I need to do it now, then it's not so deferrable, right? So you really got to look into the specific details on the grant and what they define as non-deferrable expense, because I do worry that what they mean by that is, I've got a mortgage payment to make on my business, I've got contracted loan payments to make, I've got contracted rent to pay, right? Whereas advertising to a certain extent is discretionary, right? I understand that it's definitely required to operate your business, so you might be able to get it in there, but yeah, you really got to look at specifics.
Okay, awesome. Thank you.
No problem. Is Kelly still here? We deferred her question to the end.
She doesn't seem to be.
Okay. In that case, I think Suraj has his hand up.
Yeah, this is for Aaron. I just checked for the loan thing. It says that you do have to have employment income paid in 2019 to some extent. So I think that you must have an employee to qualify for this. Yeah, between 20,000 to 1.5 for 20,000 or less in total employment income paid in 2019 calendar year?
There's actually a second part to it as well. For businesses with a payroll of 20,000 or less are eligible for 20 estimated non-deferrable expenses between 40,000 can apply for CERB. So as long as your expenses are more than 40,000, so this is the.
I did know they made they made a number of rounds of changes to this stuff.
Yeah.
At that point, then again, look into the definition of non-deferrable expenses. Sorry.
Can you apply to that loan as like a new business? Like say you've been working on your business and then you like register your business, all good, and then you can apply for that, Aaron? Because my friend she works at a bank and she was saying that like people are coming in trying to get that loan that are just starting, but I don't know if it works for like businesses where you just started, which would be actually awesome. Yeah.
Well, you have to be registered before March of 2019. March 1st of 2019.
Okay, that makes sense.
Yeah. So I mean, yeah. Again, make sure you look at all the details. Yeah, a lot of these things have come out with these great headlines, and then there's so much small print, right? So, yeah. Unfortunately, I haven't had a chance to look through the fine print on this one, but yeah. All right. I think I have a minute left for any final questions.
Suraj?
I have one last question. I don't know if you covered it or not. Just to make sure, if you're claiming a home office expense, is there a certain amount of work that has to be done from home, or?
Yes. So let me see if I can pull up the website quick.
I'm gonna have to stop sharing and reshare her.
Yeah. Okay. You share.
I think it's around, I think 50%, like it has to be at least 50%.
Okay. So as you see on the screen, so this is what you get from, like, honestly, I just Googled it, but this is the Canada.ca is the website you want to look at when you're trying to understand for sure. This is like the best source I always try to start at anyways. So you have to meet one of the following conditions. So either it has to be your principal place of business. So principal, when defined in the act, means 50% or more, right? So more than half, or sorry, not 50% or more than 50%. So greater than half, okay? The second possibility is you use the space only to earn your business income, and you use it on a regular and ongoing basis to meet your clients, customers, patients. Right? So basically, you know, if you've got an office where you're actually having people come in and then you don't also use that office for watching TV in, right? That's the other way to kind of get into it. But that's where I was saying, you know, it's supposed to be your principal place of business.
Yeah, thank you.
No problem. All right.
All good? Any last questions? Cool. All right, you want to stop sharing it?
Yeah.
Oh, you know, I can stop you from sharing it. Look at that.
Oh,
I'm so skilled.
you fancy.
I am. All right, everyone. So we are going to take a 15-minute break and then come back and dive into some of the bookkeeping statements that Taylor touched on a little bit, but we'll go into them in some detail. So if you are there and you are able to turn on your cameras, please do so, so that we can give Taylor one of our waves goodbye. So thank you all so much for your attention. I know tax is not the most fascinating thing for most people, but I appreciate your attention all the same. So thank you very much. Thank you, sweetheart. Bye.
See you guys. Yeah, it was great meeting everybody. Have a good one.
All right. We'll see you guys back here at 2 minutes to 12, okay? All right. See you then.